afternoon, everyone, and welcome to BondLab, the Generating Bond Investment Ideas for India and Beyond webinar. I am Ksenia Dmitrieva, International Business Developer at Cbonds, and today we're opening the lab. This is not only a theory session, it's a practical walkthrough where we will also see how actually bond ideas are built, from smart bonds screening and analysis to trade execution. As Cbonds operates as a global data vendor, our strength lies in delivering transparent, structured, and reliable bond data to support investment decisions. But data is only one part of the journey, right? So that's why we decided to also invite our partners from BondVue, a trading platform born in India. And so please meet our seasoned speakers. Vedant Lohia, co-founder and CEO of BondVue, Sanjeev Kumar, founding member and co-CEO. And of course, I'm also pleased to be joined by my colleague, Max Zenkov, head of India Bond Market Data, who has already supported me in several previous webinars with sharp, timely insights into the latest developments in the Indian market and beyond. So, greetings, dear gentlemen. Let's roll up our sleeves and get started. Also, dear participants, please use the Q&A box to ask all your questions to our speakers, and in the very end, we will try to address each of them, of course. Let's get started. By tradition, we will start with a presentation on the macroeconomic developments and global environment, as understanding of the broader economic backdrop is essential for bond investors. So I'll hand it over to Max Zenkov, who will unpack these global trends and show how these developments impact the Indian bond market. So Max, you are very welcome.
Hi everyone, very pleased to continue our webinar tradition. So it's quite an ambitious task to describe the bond market tendencies globally in a 10 minutes time frame. So I will try to draw a sort of a sketch of some macro driving forces and maybe some grand trends which are of relevance, special relevance for Indian bond market dynamics as well. So let's start. Of course, if we take a look at the headlines only, we would probably point out that one of the key tendencies shaping the global bond markets today are growing sovereign borrowings everywhere, be it a developing country or a developed one. In any case, we can see that governments are spending more, or governments try to stimulate the economy by trimming fiscal pressure and so on and so forth. So they need to reach out to the bond market to compensate for this. We can talk about France, Germany, other European countries. We can talk about Japan. We can talk about China. In any case, we, for the majority of the world economies, can see a sizable increase in the quantum of bond market placements, sovereign bond market placements. For instance, in case of Germany, we can see that compared to 2016, now the monthly borrowing is around 2 times higher. In terms of France, it's a third, is higher by a third. So it's sizable. And importantly, it means a serious test for the absorbing capacities of the bond markets. In Japan, for instance, for the last month, we could see several instances where government failed to market long-term bonds to the market participants. So yeah, the danger and the problem is there. certainly. And in case of India, much has been discussed lately about not only sovereign bond issuance, but also municipal bond issuance, which by this terminology are not like municipal bonds issued by cities, but state development bonds, bonds issued by states. And like both for sovereigns and for municipal bonds, the long-term trend is upward for sure. Posing questions as what would be the influence on broader yield dynamics in the market. So, what is the more global meaning of all this? I think the novelty here is a serious reassessment of developed market risks from the United States to Europe, Japan, and beyond. Um, where sovereign debt sustainability comes into question, even though like before these markets could be considered sort of rock solid. Of course, geopolitics plays its part as well, but the outcome here evidently is increasing, like changing risk profile of both sovereign and corporate issuers. And we can see this actually translated into T-spread terms in the graph on the slide. By arrows, I marked India's trajectory. And we see that India, 5 years ago, was substantially higher than most in terms of T-spreads. And here we are talking about corporate investment grade bonds. It was substantially higher than for example, Saudi Arabia, then France, then Japan. And now this gap is significantly lower. In part, it demonstrates India's improvement. In part, this demonstrates deterioration of risk profile in developed markets. In general, DM yield discounts in USD bonds, for instance, are becoming more shaky. But this works not only on the level sort of playing field of USD bonds, lingua franca or currency, common currency for international borrowings. It also translates into local currency sovereign yields. Here we can also see that like Indian local currency yields 10-year on 10-year bonds are now much closer to again, Germany, United Kingdom, France, Japan, and so on. But the question here is this a sign of improvement or also a challenge? Of course, as it goes from how I frame this question, of course, there is a challenge here as well. Let's take a look at the liquidity situation in the global markets. For example, Bank of International Settlements has recently posted September data for global liquidity, and what we can see here, generally, liquidity conditions are favorable and accommodative of more debt to come to be issued, but the mm, subdivision is very different for developed markets and developing ones. We can see that, for example, in United States, the red line of local credit change is in negative zone, while cross-border credit is growing steadily. Same picture in Euro area, and completely opposite picture in emerging Asia, in Latin America, in emerging Europe. So cross-border credit is sort of on retreat, while more credit is sourced from local sources and in local currencies. And it, of course, it indicates the causality that elevated developed market yields attract a lot of international flows, which previously hunted for these high yields in the developing countries. And the global impact of this is the fact that strengthening local markets' credit capacity, especially for developing countries, is becoming really paramount in the framework in against the backdrop of elevated yields in developed market space. And this is, I would say, the pinnacle of my presentation, the importance of strengthening local currency bond markets under the current scenario. And very interestingly, partly connected to this, is to observe how uh, the international bonds are being framed now and how this is changing over time. We can see here share of USD international bonds in total number of international bond placements. And whether we take larger ticket issues or all international bonds, the USD dominance in international bond space is very stable. So it's convenient both for investors and for issuers to some extent. But it's really interesting to see that this global liquidity still chooses this a particular form of debt really, really extensively. And having said that, let's switch to a quick analysis of how Indian companies borrow funds through bonds internationally. So here we can see placements and net placements, so placements minus redemptions in the same year of USD international bonds issued by Indian corporates. And we can see that after 2021, even though the actual quantum of placements could fluctuate, the net placements are mostly negative or close to null in terms of, if you take, for example, the year of 2025. So what does it mean? It means that mm, mainly we see here a sort of substitution of maturing amounts to a large extent, though there are, of course, debut issuers as well. But mostly we see substitution of previously taken loans, bonds by the new placements. And of course, we know that the funding needs of Indian companies are growing, so they need to borrow more as they develop their business. But looking at this graph, we can see that there is no substantial increase in borrowings by large Indian corporates through international bonds. What does it mean? It means that a local currency bond market is developing quite steadily, giving these large corporates the possibility to borrow ever-increasing amounts locally, not turning to the global venue. And here it is also important to mention that a large portion of these international bonds issued by Indian corporates is issued by banks or non-banking financial companies. So essentially, it arises from financial sector. Of course, for financial sector, it's really important to keep some portion mm, of loans or bonds in different currencies to ensure this funding diversification, which actually seems like a major driving factor between the most of the placements we have seen lately. And of course, here an important factor is the rupee exchange rate versus USD. Year on year, USD overall, DXY index indicated that USD weakened by almost 10%, but rupee weakened in turn against USD, meaning that both for international investors looking at the Indian market and for Indian issuers searching for possibilities to raise money abroad, this of course create a hindrance. At the Cbonds platform, you can use the instrument of consensus forecasts, which you can see at the slide. The left part is RBI exchange rate, and the right part is the consensus forecast collected by us with number of market participants. So essentially, in terms of borrowing strategies of Indian companies, one can encounter a contradiction. The spreads, the T spreads, are quite low, and this looks favorable for borrowing through international bonds. But on the other hand, the local currency bond market is growing and becoming more accommodative. The overall yield level in USD bonds is higher now, and also the rupee has weakened with the prospect of further weakening, making the repayment calculations more complex. So I think I will stop with substantive content for now, and let me just mention some highlights of coverage in the Cbonds database. We have full coverage of outstanding INR bonds, full coverage of international bonds of Indian issuers. Everything is easily trackable via Bond Screener, which Ksenia will show later in detail. We have extensive emission documents coverage, also macro indices, consensus forecasts, as I have mentioned already, prices from exchanges, market participants. So there is actually quite a lot to explore, and we invite everyone to look through our platform later after the webinar. Thank you.
Thanks a lot, Max. It was a very comprehensive overview, I would say, of the global trends. And maybe this is the first time when I want the consensus focus to be wrong. I mean, like the INR and USD, the one that you've shown. So let's hope that the things will change in a positive way as soon as possible. And now I will call our partners from Bondvue part. So I would like to call Sanjeev, Vedant. So please start your presentation. And as we discussed, we will probably dive into the local Indian market, right?
And in next 15 minutes, I will try to give you a glimpse of how we are basically forcing the Indian market, and why we believe that this is the first time we are seeing a complete bubbling of, or the undercurrent is so huge that we are seeing a huge retail participation when it comes to Indian bond market. So if you see why India and why now, this is the pertinent questions that basically, whether it is global investors or whether it is domestic investors of any nature, be institutional investors or semi-institutional investors or retail or HNI, they're asking this question that why India and why now? So the answer lies in, there are three basically the critical factors which are confluencing for the first time in India. The three critical factors are, first time, if you see, the macro stability is very, very strong as regards Indian market is concerned. Second, which is extremely important for the development of any the capital market, and understandably for the fixed income market, is the regulatory reforms. Third is basically the creation of digital market infrastructure. These 3 points and these 3 critical points are confluencing for the first time. And if you see the data point, the Indian key macros data point, that is getting reflected here. So if you see the headline CPI number, it is 2.75%. It is very low. If you see the repo rate, that is roughly 5.25 to 5.5% repo and reverse repo rate, which clearly shows that the first time, if you see the real yield, it is the positive. The fiscal deficit is basically 4.8% of GDP. That clearly shows the fiscal consolidation which the Indian government is displaying. And if you see the current account deficit, it is under control. It is roughly 0.6 to 1.3% of GDP. So the point which I want to make is that the macro stability is the critical point which is getting reflected in this number. So definitely, I will talk about, I think Marx have comprehensively covered the size of, the global market and the dominance of US market. US is roughly, if you see, roughly, $33 trillion, where, if we see our, the India's bond market is just, $2.2 trillion. Whereas even if you see, some of the developing countries like, Brazil, which is at $2.5 trillion, which is ahead of India. But if you see other developed, the countries, which is roughly, Japan is $12 trillion, US is $33 trillion, Eurozone is $13 trillion, China is $20 trillion, India is $2.2 trillion. But if you see the component of Indian bond market, and why I'm showing it to you, because that will give you a brief perspective of mammothness and size of or the percentage composition of the various critical components of an Indian bond market. As you know, that Indian bond market, basically there are three critical components. One is Government of India securities. The second is state government bonds, and third is the corporate bonds. Definitely, there are some ancillary components are also. I'm not covering that, but these three critical components, if you see, Government of GSEC is roughly 46% of overall Indian bond market. SDL, that is state government bond, is roughly 26%, 27%, and corporate bond is 22%. But irony is that if you see, the composition of this corporate market, majority of this bond is tilted towards AAA rated, the bonds, and majority of the issuances of the bonds are happening through private placement. And as I mentioned, when I started the presentation, that the three critical components, that the regulatory reforms, macro stability, and digital market infrastructure is confluencing for the first time. And probably, I think, we are at a cusp where, we will see definitely a mammoth growth in Indian bond market. We have seen, the growth of Indian bond market. That is if you see this data point from 2025 to 2025, 2015 to 2025, the growth is in a band of 11.85%. But that is not saying, or that is not basically reflecting the true picture. This 11.85%, I think for the last 10 years, if you see, the growth is in that band itself. What is more important is to see, how, the retail bond trades are happening, So if you see, I'll just give you a brief backdrop. Probably, we are not covering in this presentation, but I will just give you the brief backdrop, and then you can understand the undercurrent which we are seeing for the first time in Indian fixed income market. In 2020-21, SEBI came out with, to basically transform the Indian fixed income market. SEBI came out with the guidelines that is called Online Bond Platform Provider Guidelines, to ensure that there should be a digital infrastructure by which basically any retail investor can participate. And if you see the growth of basically the trade on OBPP platform, it is mammoth. Let me tell you, it is mammoth. In 2024-25, the number of trades were 2 lakh trades happened in 2024-25. But in 25-26, the number of trades are touching close to 14 lakhs. It is roughly 7x jump. What is more important to understand is that if you see the volume of these trades, that is just 20% jump. The 2 lakh, number of trades 2 lakh. And if you see the volume of that 2 lakh is roughly 10 lakh crore, whereas if you see the number of trades of 14 lakhs, the volume is roughly only 12 lakh crore. What does it mean? It means that the retail participation is going berserk. That is getting reflected in the number of transactions or number of trades happening on RFQ platform. That is the undercurrent, which is very, very important for all of us to know, and which is very, very important for all the participants to know that the fixed income market for the first time in India is seeing a mammoth growth. And I just want to compare it with the growth that we have seen in Indian equity market or Indian mutual fund market or Indian, the demat account opening. I'll just give you a brief number. Probably that will give you some sort of, idea that what I'm talking about. In 2014, you won't believe, I think, everyone talks about, the systematic investment plan, SIP. Most of our global investors who have attended this attending this seminar may not be aware about SIP, but SIP has become a ritual in Indian savings parlance. SIP means every month, someone is investing some fixed amount of savings in mutual funds. So SIP number, you won't believe, SIP number in 2014 was only 1,200 crore per month, which is right now touching 32,000 crore. Can you believe in just 10, 12 years, that number is, I think it is roughly 30, 35 times. So that is the number that is creating that has created the undercurrent in mutual fund. And why it has happened? It has happened because of only three factors. Number one is the transparency, number two is the ease of execution, and number three is awareness. Similar thing happened in the equity adoption. If you see equity market, that was roughly 70 lakh crore. It has gone to roughly 500 lakh crore. And similar thing, we have seen the adoption we have seen in equity market, and similar trend we have seen in demat opening. Definitely equity and demat, they are interrelated. So 2 lakh crore of demat account that has purged and swelled to roughly more than 16 crore, 2 crore demat accounts swelled to roughly 16 crore demat account. So these three things in the same ecosystem, if mutual fund grew, if equity grew, if demat account grew, why the fixed income, they have not grown? They have not grown because of lack of the three factors which I told. That number one is basically the transparency, number two is basically awareness, and number three is the digital infrastructure. For the first time in last 3-4 years, we are seeing the regulatory impetus by Government of India, whether it is on institutional level or whether it is at retail level. At institutional level, whether it is basically removal of the caps on fully accessible route, where by RBI in 2022, or whether basically the inclusion in JP Morgan index, in global bond index, that has really created some sort of the inflow. But apart from that, what is more important is to understand what is bubbling and what is happening at retail level. And where I clearly mentioned, it is basically the advent of online bond platform, where I clearly mentioned that the growth of the RFQ volume, not in terms of volume, but in terms of number of trades, that is mind-boggling. And for the first time in Indian, the fixed income market, the three factors which we are missing, that is the transparency, that is the ease of execution or awareness, it is basically coming at forefront. And to my mind, which will create the same kind of growth which we have seen in mutual fund, the same kind of growth we have seen in equity, and same kind of the growth we have seen in demat. There is no doubt in our mind, from Indian market perspective, working at ground level, we can clearly tell you with confidence that I think we will see the similar kind of the growth in fixed income market, and we have been seeing it. See the kind of the public issuances we have been seeing. If you see last 5-6 years, number of public issuances definitely grew from 3,000 to 6,000. But now, every month you'll see 2, 3, 4 public issuances which are coming. So the skewness which was there towards private placement market, that is getting changed. The skewness which was there towards only AAA rated and sovereign rated bonds, that are getting changed. And now lot many the bonds are coming, the A-, A+, and even in AAA categories bonds are coming, whether it is in terms of private placement or in terms of the public issue. So the point which I want to make is the undercurrent is the bed is absolutely ready, and we are at a cusp of big growth, big bull run. I will say the bull run. Typically, the investor or the market participant talk about bull run in equity market, but we are going to see a big bull run, mammoth growth in fixed income market, and all the undercurrents which are required to basically give a impetus to bond market is completely ready. So this is basically, I thought in just 10 minutes, I should give you a brief picture of what is happening at ground level. Now, even the global investors, they are not seeing India as a tactical allocation. They are seeing India as a core allocation of their allocation of portfolio. So with these thoughts, I think in just 10 minutes, whatever has come to my mind and whatever I thought and whatever basically my experience and learning has been by meeting various participants, I thought I should basically articulate in a manner. Now, I'll just tell you two, three more points, which is very practical in nature. I think, and probably I think our Indian participants can very much correlate. The development of mutual fund market happened because of the awareness created by AMFI. AMFI is an association of mutual funds. They have created a huge awareness and they have created a tagline, mutual fund sahi hai. You won't believe, just last week, SEBI along with BSE and NSE, and along with OBPP, that is Association of Bonds, they came out with a tagline of bond ek sashakt bandhan. Probably I think global participants may not be able to understand Hindi, but Indian investor may correlate. It means that the bond is a strong bonding. So bond ek sashakt bandhan, this is the tagline they came out with, and they are going to create awareness and mass media awareness, and probably we will see a major the growth going forward as regards fixed income market. So tighten your belt, gentlemen. I'm sure you will see a huge run up going forward. I think more and more investors will definitely come, and the shift is all poised to it is ready. The fixed income, the fixed deposits which are lying in banks, they are going to get shifted to fixed income market, whether it is the secured bond or whether it is state government bonds or whether it is municipal bonds, and understandably so, because government they are also coming out with a lot of you can say taking a lot of budgetary initiative we have seen in terms of providing liquidity, providing an incentive to launch municipal bonds, that has also come. So all these the critical components are ready, and we are very sure that we will see a mammoth growth. So with this, there is a poll time, and probably then after that I will hand over to my colleague. So poll is, what best describes you as an investor? The question is, I actively invest and trade in bonds. I invest mainly in equities, but also in bonds. I rely more on bank deposits or other traditional instruments. I am here to understand bonds from scratch. So with this, I'm just taking a pause, Genia. I hope I have taken 11, 12 minutes. I'm not too sure whether I've exceeded my time or not.
Yeah,
But
no
over
problem.
to
It
you.
was
Yeah.
very informative. Thank you so much for this introduction to the Indian bond market. And yes, please, participants, take your time to respond to this poll, that the one that Sanjeev has shown on the slide, as well as your questions, because I already see that we have some of them in the Q&A box. So feel free to ask your questions. We will of course discuss them at the very end of this session. So thanks again, Sanjeev. Actually, me and Max and also our founder, we're going to Mumbai in March, so it will be very interesting to discuss everything and to learn more about Indian market, maybe in March as well, like in person.
Oh,
We
sure.
can discuss the
Most
trend.
welcome.
Yeah, but this is after the webinar, of course. Okay, so thank you again. So now the first part of the webinar is actually ended. We already started all the theory, and now we will smoothly go forward with the practical approach of the same. Right now, I will share the screen, and of course, as the name suggests, today we discover the global markets and the Indian markets from the point of perspective, like from bond screening to trade execution, right? So, and here at Cbonds, since we operate as a global bond data vendor, of course, we will focus more on the bond screening, and then our colleagues will comment more on the trade execution. So that's why let me just briefly remind you who we are and what we do. So Cbonds is a financial data provider, like with the headquarters in Dubai. So right now we have more than 1 million bonds in our database covered globally. There is no specific focus on developed markets or emerging markets. We cover the whole world, 200 countries, with a 100% coverage of Eurobonds. And Cbonds is not only about bonds right now. So we also provide comprehensive data for stocks. You can see the numbers right now on the slide for ETF and mutual funds, for indices, in case you track macro, as we discussed, because it's very important for investors. And of course, the toolkit, which will also add a lot of value to your day-to-day workflow with bonds and other assets. So we have clients from over 100 countries, and the 5 main countries, let's say, where our clients are based, you can see right now on the screen. So we also host our annual conference in the UAE, in Dubai. So feel free also to come to this great event. So we usually host it in November. You are very welcome to join us as well. And also a little bit about our audience. So right now we have over 1,000 institutional clients. Since we are not new in the market, we operate since 2000 year, and of course we already have reached many people from different countries and of different profiles. As you can see, it's about audit companies, family offices, private investors, fintechs, who usually use our data via API to get the quotes and things like that. So also banks, of course, as you can see right now on the screen. And what are the tools, of course, that could help you, that could add value to your workflow? So as we already discussed, of course, you need a powerful tool to screen these bonds, to look for only those positions which perfectly match your criteria. And it's not only about India, it's about the whole, I would say, universe of bonds. So, and here we go. So we have the powerful search for bonds, stocks, ETF, and funds. We also implemented AI bond screener, which is very new. It's a brand new tool, which I will show you a bit later. It's very convenient to use nowadays because AI is everywhere. Watch list, portfolio to monitor your assets, to see the performance, to get the notifications and so on. Mobile application to have these tools on the go. And of course, Excel add-in and API in case you work a lot with experts, in case you work a lot with the Excel tool and things like that. So let's move on. Since we covered the macroeconomics, I would also like to add something about this macro situation. So on the website, we can see GDP growth rate per year in percentage. I would like to show actually the comparison between China, between India, USA, and Germany, so that we could see the situation between these emerging markets and developed markets on one chart. So this is actually what a macroeconomics section, what macroeconomic chart can allow you to do so. So as you can see, India hits the higher point here in terms of this comparison. So it's very valuable if you decide to enter the Indian market. This information is very crucial for each investor. And of course, also apart from this macroeconomics, it's crucial to check yield curves, right? So since Sanjeev already covered this point regarding the local bonds in local currency, I will just add that Cbonds also has this INR curve, which you can see, which you can also upload with the historical date to see the spread between the last year, for example, value and today. So just again to make your analysis to understand if it is a nice idea to enter this or that market. It is up to you here, as you can see. So, and of course, as I mentioned, we implemented AI bond search. It's a very useful tool which you can use as, I don't know, your favorite search engine, like I will not say the names. So you can just type like show me INR bonds, or maybe show me euro denominated bonds, investment grade, non-investment grade. It depends on what exactly are you looking for. And the system will show you the relevant positions according to what you have written. So now we have INR bonds issued in India, in financial sector with yield over 10%. You can see the basic information here, but in case you will be interested in knowing more, you can of course just click on this bond and get to the separate page with all the information available regarding the quotes, regarding the documents, and everything is available just by a click of your mouse. And of course, for those who likes our bond screener, I would say old-fashioned, but still it's very also convenient for some people to choose these filters one by one, when you can try all these criteria. So it's up to you. It's also available on our website, and right now you can see that I'm trying some USD denominated bonds of sovereign sector, safe search, triple B. With the yield starting from 3% to make it a little bit more interesting, I would say. So, and yeah, here you can get, I would say, the same filters, the same fields that we already discussed. You can download it, you can visualize it on the market map to see again the spreads between different positions. We have Aruba here actually with a 9% offering, so I would say it's risky, but still you can also add the benchmark here, like US Treasuries, for example, zero coupon, to see again the spreads. And they will be really high here, as you can see, since we just made the search with the yield from 3%. Again, you can analyze it, you can download it, you can use it in your presentation, you can send it to your client. Again, it depends just on your use case. It's up to you how you will use it. Just make the most of this tool. And of course, if we take a separate bond and analyze what we have for it, I have chosen a random Mexican bond just for your example. So you can see the prospectuses here, you can see the prices, which are posted with a 15 minutes delay, and end of day prices are also stated here. As you can see, you can get the chart, you can see the dynamics of price, of yield, to G spread, again, everything that is helpful for your daily analysis and getting all these relevant values. So if you scroll down, you will find all the comprehensive data regarding this bond and regarding its issuer. You will get the volumes, you will get the cash flow parameters with the also schedule. Let's say you get the next date of the coupon. You will see the ratings, the historical data of them, and of course, if you'd like to study the appetite of the bond, of a particular bond or a stock, you can also check the holders section, and etc., etc. So of course it's better to try it on your own, to try your own ISINs, stickers, and so on. So this is also something that I will let you know a bit later regarding how you can do this. And to track all these bonds, assets, we of course have at least two tools that would help you to do so. We have Watchlist, where you can upload all these bonds, stocks, ETFs, indices, and keep tracking them on a daily basis to see the change of values, whether there is like a drop or an increase. It depends of course on the market, but you can track it here. And Watchlist is also available in the mobile application. You can set up notifications regarding coupon payments, options, changes in rating, anything, just so that you could stay online with your portfolio, so that you could track and not miss the important events. And of course, price yield alerts. In case you're chasing a particular value of price of yield, you can easily set it up here and keep tracking. And portfolio. So actually, I have a very small portfolio in USD. Maybe it's an example, but maybe not the best one, because I have just seen that there is like some kind of a fall from a cliff. But still, it's just like an example. You can use this portfolio to track the performance of it, to see the average yield, average duration, to see the portfolio breakdown, which is also very convenient in case you have different sectors, you have different assets, and so on. You can see the shares of it, and of course see the coupons, the dividend in the very same page. This is the portfolio tool, which is also available right now on the platform and available for your testing. So, and it's up to you. Again, you can try anything. In case you are tracking INR bonds, you can easily track, just like try the filters that we discussed with the INR bonds. Maybe you have some even more exotic requests, you can easily try them on the platform. And that's also something that I would like to offer you. So you can start your free trial just like after this webinar. I will activate 10-day free trial for anyone who would like to let's say have this practical approach with our platform, who would like to try their strategies, to try a portfolio, watch list, and so on. So actually, the trial allows you to use the whole scope of our tools. You will get the whole database, the whole universe, and the tools to understand if it adds value to your research or not. So feel free to write me in LinkedIn. You have also my WhatsApp QR code here. Just scan it, leave your request, and I will rapidly activate the free trial for you. So thank you so much for your attention. This was about the bond screening. And now I would like to move ahead with Vedant's presentation of their solution. So Vedant, BondVue is a bond trading platform located in India, right? So that's why we're very interested to know the peculiarities of this platform and the trade execution and all the details. So please, you're very welcome. Feel free to tell us everything that you have prepared today.
Absolutely. Thank you so much, Xenia. Thank you, Max, and thank you to the entire Cbonds team. Just before I jump into the bond execution part and how we at BondVue help you do that, just connecting what Sanjeev spoke about earlier about Indian and global markets. So if you look at all the emerging and developed economies, we have Japan, US, you have the entire Eurozone, you have China, Brazil, India. And this is how the states would fall given their sovereign debt to GDP ratio, which is a very important indicator telling people what is the sovereign debt, what is the debt that the government is raising as a ratio to their current GDP. And you can see where each of these nations stand, with Japan, of course, being the largest public debt to GDP ratio market in the world. After that, the USA, Eurozone, etc. And India falls somewhere in the higher order of the emerging markets, which is yet shallow, but growing very steadily and hence a very large opportunity. So while you were actually collating this information, we thought let's do a quick exercise to understand that, hey, what if I invested 1 million across global bond markets 10 years ago, across all these economies which we just spoke about? What would be the value of my investment today? And while we did that, we found a very interesting analysis, and hence we wanted to present it to you, is that this is how it would look, right? So let's look at the right side first, wherein if you actually invested 1 million, India as an emerging market would be the highest, followed by Indonesia, then Brazil, then Mexico, South Africa. These are your five key emerging markets in the world. And then you have your developed economies, which are US, UK, Germany, and Japan. And this is the actual final value of your investment if you invested in a 10-year government bond, which is the benchmark bond of any country that you invest in, which is also called the risk-free return that you get when you invest in a country. And on the left side, we've tried to draw a kind of parallel to show you how the bond yield would move in all of these economies. You can see most of them are very volatile. For example, the orange one, which is Brazil, you can see how volatile it is, and a couple of others as well. The upper half of the graph is all the emerging markets, because usually yields of emerging markets trade about 300 to 700 basis points above developed economies. And in emerging markets, this blue one that you see over here is India. So this is not just about yield. Maybe the yield is lower, but it is also about volatility management. It is about stable rate cycles, which the country assures you. And that is what we're trying to draw, which is a very interesting analysis. And even if we take the USD adjusted real return, India and Indonesia after that would fall as the top two, and then the other economies would fall into place. So we just did a quick understanding to know that what would actual money's value be if you invested 10 years ago? And this is the kind of analysis we got. So with that, we have another poll up for you. As what is your preferred yield range to invest in bonds? And the options are below 5%, 5 to 8%, above 8%, or need more clarity before you start investing. And we know somehow the chat is disabled. So there is a Q&A box in which you can just click. There'll be an option called ask a question, and we'll request you to just put in your answers on that because you're not able to put it on chat. So you can just take, say, 10 seconds, think about your answer, go to the Q&A, click ask a question and put in your answers over there. And you can just send A, B, C, D, whichever works for you. This is just for us to understand what is the risk appetite or what is the yield range that you would like to work around, right? Thank you. I think a lot of you have started responding, so thanks for that. Thank you. We'll move on to the actual trade execution part, which is on BondVue. So BondVue is a SEBI-registered online bond platform. And as Ina was saying previously, after understanding all the amazing information that Cbonds has, I'm sure many of you would be very interested to explore the bond market, to actually invest in it. And for enabling investments in Indian bonds is where BondVue comes in. We are a marketplace facilitating seamless bond investing, trading, and management overall. And our USP lies in two things. Number one, we're a registered debt broker with SEBI, which is a Security and Exchange Board of India, which is the regulator of the capital markets in India. And we're a licensed online bond platform with NSE, which is one of the key exchanges in India. And our USP lies threefold. Number one, we're able to help you discover price transparently, yields, prices, etc. We have a host of bond market analysis tools specific to India with a very simple bond screener, etc., which you can use, or a calculator, yield to price or price to yield calculator, and bond portfolio management as well, which you can do on our platform specific to Indian listed bonds, all in one unified platform. The working is very simple. The graph or this diagram may seem a little confusing, but you as an investor over here can log on to online platform like BondVue. You do your very simple KYC through the platform. And once that is done, you are able to immediately trade, execute, and settle all your bond trades through our platform, which is all linked through the exchange, which is either NSE or BSE. And there's something called as exchange grievance redressal, which is provided by the exchange as well as the Security and Exchange Board of India, wherein any grievance that you may have, any trouble that you may be facing on investing on these platforms, there's immediate support that you can reach out to them and they resolve it within a few hours. So that becomes very beneficial for you when exploring a new platform. The focus products that we have on our platform is listed government bonds and corporate bonds, which are the hero of our conversation today. Government bonds comprise in India of your central government called GSEC, SDLs, strips, T-bills or zero coupon bonds, and listed corporate bonds such as your private PSU or tax-free bonds. We also have primary issuances, which are your public issues, something like an initial public offering, like a bond IPO that you can get on our platform. And also corporate fixed deposits, which is a very good comparison between any safe investment that you are looking at as compared to bonds. The second option would be corporate fixed deposits. So that as well. So that's what we offer on the platform, right? And with that, we have another interesting poll that's come up for you. So would you consider investing in global bonds? I think all of us has spoken about how the economies are functioning, how you can use Cbonds as a platform. And we've shown you how you can also access bonds in India through BondVue. So after all this knowledge, if you would like to consider investing in global bonds, you can drop in your responses in the question and answer section, where if you're already investing, you can put A. If you want to, but only if risk return makes sense, you can put B. If it is investable, you wanted to make sure that it's easily accessible, then you put C. And not yet sure, you want to understand more before investing, you can put D. So you can just put in your answers in the Q&A section as well. Yeah, thank you for your responses. And with that, we complete our part of the presentation, and Zine, I think the webinar as well. We've created a quick group called the BondVue Club, which we invite you to join. You can just scan the QR code that's present on your screen and you can join. This is a WhatsApp community which is there. In this, we have a lot of interesting things that we keep on talking about. We have interactions, we have polls, we organize a lot of debates that we do, a lot of awareness sessions where we actually understand what you want to learn, and we're able to support you in that learning and understanding. So please do join our club. We try to make bond markets as fun and interesting as possible so that you're able to learn and then invest and grow your wealth peacefully. Thank you so much.
Thanks, Vedant. It was very interesting and I would say also visual. So, and engaging, of course, because I see that we have some responses in the chat. So the most of the audience is actually the chosen C, as you can see, above 8%, like to the poll that you had, like the second one. So it's also very interesting to know. I think that now we actually can turn on the cameras because we will start our Q&A session right now. Because trust me, we have some questions here from the audience. For those who haven't written their questions so far, feel free to leave them in the Q&A and we will also discuss them. But maybe we can also start from a question from me. Actually, when I was preparing the presentation, I was interested to understand what let's say what are the key factors that retail investors should consider before adding bonds to their portfolio in the current terms. I mean, like in terms of the Indian interest rate environment and things like that. Because we discussed like high volumes, right? So, but what about retail investors? So, colleagues, please, from BondVue, you are very welcome to answer this question.
Lovely. So I think from our end, Sanjeev, if you would like to take that, please.
Oh, sure. So if you see the mindset of retail investors, typically they chase high yield bonds. Whether it is right or wrong, that's a different story altogether. Definitely that is wrong. What any investor, I will not classify it as a retail or institution, but definitely any investor for that matter, who basically invest in bonds, they should have a proper framework. The framework is basically associated with the risk that they want to take, the basically the need, the goal, the cash flow that they are basically thinking of. Accordingly, basically, they can pick and choose, and curate the portfolio. The portfolio can be, a very safe portfolio. It can be AAA rated bonds or Government of India securities, GSEC, they can invest, or they can go down the curve and they can invest in some A minus or A plus bonds. But if you create a right kind of framework, which basically is linked to their goal, their cash flow, that would be the right way to basically create the portfolio. What we suggest to any of the investor is that there should be 4 buckets to choose the bond. One is basically the liquidity bucket. The second is the stability bucket. The third is basically the yield kicker bucket, and fourth we call it as a cash flow generating buckets. So you should have a very comprehensive portfolio under these buckets, which should basically be aligned to your goal and aligned to your need.
Okay, nothing to add, actually. Maybe also the second question. So maybe you could also respond, how has increased foreign investor participation changed the execution standards, if at all? So do you know this? Can you comment on this question as well?
Can you repeat, Jamie, your
Yeah.
question?
How has increased foreign investor participation changed execution standards, if any?
No, definitely. As regards, if you see the foreign institutional investors or foreign investors, typically they are, I will call it as a institutional investors. They will not be classified as a retail investor. They will be classified as institutional investors. So they have been, definitely government has been, giving a lot of incentives and opening, changing a lot of, the regulatory norms to ensure that they basically come to India. For example, inclusion of the index in JP Morgan index is one of that, the kind. So as regards digital infrastructure is concerned, that has been there, so probably only one thing which will basically entice or invite or, so to say, excite the institutional investors or FPI or foreign investors are one is the regulatory push from government side and consistency of regulation from government side. If you take care of these two things, foreign institutional investors or foreign investor will definitely come. Leaving apart the yield part and the other part, because definitely rupee is right now weakening, so probably that is not in favor of the FPI because rupee is depreciating. But it's just a matter of time once that will get stabilized. I'm sure the foreign institutional investors or investors will definitely come into India. As regards retail investors, definitely the story is completely different because they normally seek for transparency. They normally seek for ease of execution. They normally seek for some sort of, you can access to the proper information. So there, the situation is completely different. But as regards your question, it is under, the institutional framework. So probably the regulatory push will be the one factor which will basically excite, the foreign investors.
Just to add on to that really quickly,
Yeah, sure.
yeah, for international investors, I think the main focus over here, of course, is accessibility, right? Like today, even we being in India want to see how we can invest in US bonds or we can invest in developed economy bonds, right? But accessibility is the key factor. I think people today are so well educated, like everybody has ChatGPT or Perplexity or some AI tool, Gemini, which they can use to get information. But accessibility is what is the key factor and the ease of understanding it. And that's where the Indian government has really opened it up a lot with like what we spoke about online bond platforms in India, at least. Even NRIs or even people residing outside India who do not have a residency of India can invest in the Indian market, either through their company or individually. And they can do it online through platforms like ours. We're not the only online platform. Of course, there are multiple of them. You can choose whichever one you like and you can use that and invest. So I think that's one of the key ways through which the government has opened up access to international investors, and they'll be doing a lot more in the times to come. In fact, the inclusion in the indices, the JP Morgan index or the Bloomberg or the FTSE, which has come, is to help people actually understand that, hey, you have an opportunity here which is untapped. You can access it by investing in a JP Morgan index, which is listed in the US also, and access government bonds in India indirectly through that. So avenues are multiple. And the government is really pushing, as Sanjeev also mentioned, to see how international investors can access government listed bonds and corporate bonds in India.
Yeah, thank you. Thanks a lot, Vedant and Sanjeev. We actually have one more question from audience. It is written in the chat. So the current account deficit, it is that drives the currency in a downward spiral. Any chance that this will improve? I think that Max can start, and then colleagues, if you also have any comments, you can just easily add your thoughts to that. Yes, Max, please.
I actually think that to this process of depreciation, there are two sides of factors. One is external, what is going on with the Fed decisions, like US data prints, geopolitics, of course, like we are seeing now with US-Iran talks and Russia-Ukraine. Of course, so everything like this is not under control, of course, of RBI or Indian government more generally. But concerning what is under control, I think that it's out of question that RBI possesses massive resources to intervene selectively to support rupee to make it at least sliding less in a less rapid manner. And also, I would say we should take a closer look on what is going on with trade deals, because trade deals are a major way to boost the exports. But of course, it takes time for the deals recently reached to take shape. Even with the US, India trade deal, we are yet to see what are the specific terms and these details are to be agreed. But what is meaningful here is that for example, deals with UK and the European Union are not just about boosting exports. It's also about streamlining the framework for labor migration and increasing remittances, which is also a way to mend the current account deficit problem. So I think that much is being done to stabilize it, and from time to time RBI has an opportunity and willing to intervene. And also one more thing, if export conditions improve, RBI will have more incentive to curb possible weakening of the rupee, because before that it could be viewed as a way to create more competitive conditions for the exporters. But with conditions improved, maybe the currency depreciation mechanism is less needed here. So just these are my thoughts.
So I will add few more points what Max has added. I think there are 3-4 critical initiative which are being taken by Government of India. Number one is basically, if you see the export which India is doing, it is basically towards service sector, and IT sector is one of them. So probably if they deepen their IT initiative, that can be one. And they are doing, I think taking some initiative basically to accelerate that. Second is basically, if you see the manufacturing sector, Indian government is focusing more on manufacturing sector, to make it more competitive, So that will really help, to basically reduce the CAD. That is the second thing which is extremely important. Third is and India has already started doing something on energy side, because majority of the import, if you see, they are towards crude side, So probably if they focus on green energy and some of the alternate energy, which the Government of India have already started and giving some sort of incentive. So probably that will also help, to basically, reduce the reliance to import, the crude. So if 2-3 factors which are contributing to the CAD, Government of India is taking a long-term structural initiative, basically to reduce that CAD. So just a matter of time, and we are very hopeful, and because of which we are at the sweet spot.
Yeah, sure. Let's just keep tracking the markets and make the market data-driven decisions, right? So I think that we can actually finish for today. I would like to thank you, Vedant and Sanjeev, for these insightful presentations, for your participation today. It was very interesting to work with you, to collaborate with you, with your team. So thanks, our dear participants, for joining today, and we will be only glad to hear from you. If you'd like to join the free trial or you'd like to know more about BondVue platform, just feel free to reach us out as per the QR codes that we shared, and you are very welcome. So thank you so much, everyone. Wishing you a great day, and see you in Mumbai maybe next month.
So thank you, Jenia. Thank you, Max, for
Thank
giving
you.
this wonderful
Thank you.
opportunity to basically interact with international investors and domestic investors both. It was really nice. Thank you.
Thank you. Thank you. Likewise. Yeah. Bye-bye. Have a good day.
Bye. Take care.
Bye.